So I'm Rich Harvey. Thank you everyone for joining us today. I'm the CEO and founder of Property Buyer, and I've got with me the Managing Director of Chan & Naylor in Melbourne, Peter Lacandro. So welcome, Peter.
Thank you, Rich. Looking forward to it.
So can I just encourage everyone, a little bit of housekeeping. I'll be doing a short presentation about a property market update around the country, and then I'll have a short question time. And if you've got questions, if you could just use the chat function on the bottom of your screen, I really encourage you to put in any brief questions there, and we'll be covering as many as we can during the presentation. And then I'll be handing over to Peter to do his tax presentation, and then we will be leaving at least 10 minutes or more at the end of the webinar for your questions. So appreciate you all logging in. Hope you're all surviving the lockdown okay and staying safe. And let's get into it. So I'm going to share my screen, screen number 2, and tell me, Peter, that's all good on your part? Yep, good stuff. All right, well, let's get going. So, quick background on myself as property buyer. I've been running my business for 20 years, can't believe it. I need to take long service leave, I think, this year, and been the president of the Buyers Agent Association of Australia, and also the chairman of the Buyers Agent Chap, just to help out with professional standards in the industry, and also hold a qualified property investment advisor accreditation through PIPA, the Property Investment Professionals Association. So here's a quick update of what I'm going to present today. I'm going to present a brief outline of the market, and I'm talking about it going from white hot to red hot, give a couple of buying tips and strategies, and then talk about some case studies that you might be able to apply to your own situation. So where's the market at? Well, last Saturday, we had lockdown in both Sydney and Melbourne, which took the auction clearance rates, took a bit of a dive. Sydney's been generally trending over 80%. And Melbourne sort of the mid-70s, but obviously a bit of a dive last week. But Brisbane was still very strong at 79%, Adelaide very strong as well, and Canberra. But we should start to see those auction rates again stay in that sort of mid-70 range during lockdowns, but again trend over the 80% once we get back out of the lockdown period. If you look at, I'll do both Sydney and Melbourne here, but if you look at what's happened over the last 2 years, you can see obviously when COVID hit, major dip in the market, and then it's rebounded, gradually built up over 2020, and then really strong start at the beginning of this year. So we were getting 80–85% real boom time clearance rates at the beginning of the year. Similar situation for Melbourne, just a fraction down on the percentages. And I'll be talking about this, but I do think Melbourne's got a bit more petrol left in the tank. I think Sydney, the speed of acceleration of Sydney is pretty much peaked. Still more growth there, but I think Melbourne's got some more legs to run. If we look at price changes over the last quarter, so that's over the last 3 months, you can see that some of the major capital cities have just started to trend down. Doesn't mean the prices are declining, it just means the rate of acceleration of growth is starting to slow, as you'd expect. At one point there, Sydney was doing 3% a month, and that's generally absolutely not sustainable. Brisbane was doing about 2.5% a month. Melbourne around 2.5% a month. But you can see all of the capital cities were trending really strong. It'll start to peter out, but I think over the next 18 months, we're still going to see very strong price growth for a number of reasons. Over the last 12 months, across all capital cities, we've seen a 13.5% rise. We've seen a massive increase in Canberra, Darwin and Hobart. Adelaide's done 13.9%, Brisbane 13%, Melbourne 7%, and Sydney 15%. So it's interesting that, as I mentioned, Melbourne's lagging, but that for me is a signal that it's also got the strongest potential for uplift once we come out of the lockdown phases. Median prices have jumped quite dramatically. These are the current house and unit median prices across the cities. Sydney's a staggering $1.3 million. Melbourne's almost at the $1 million mark. Brisbane at 632. So very, very strong numbers right across the board, and yet we believe still more room to grow and more growth forward. Looking at listing volumes. Now, this is the bane of my existence, guys. Listing volumes have been very low. We're still at a 5-year below average level. So even though listings increased substantially during April and May, we're seeing listing volumes, this big black line here is still well below the 5-year average, around about 20% below average. So that's a real problem for most of the buyers out there, is that the lack of stock is definitely one of the contributing factors to prices remaining high and rising. Consumer sentiment has been quite strong. You can see here it rebounded quite strongly as we came out of the COVID phase and all the government stimulus money was floating around. However, a couple of lockdowns obviously has really dented confidence. You can see there the line is trending slightly downward, but during the last May was probably the peak of consumer confidence as we came out of the major lockdowns. And there's a really strong link between consumer confidence and people's willingness to buy a property. So just keep watching that link in the media because it definitely has an impact on when to buy or sell. So a couple of tips, buying in a hot market. Yeah, we're definitely, as I said, in a white hot market at the beginning of the year, and I believe it's really trended now to just a warm to red market. So a couple of investment strategies that I'm recommending that work is continuing just to buy and hold in high growth areas. So areas that have got good fundamentals for growth, good stable rent returns. I avoid the mining towns. I avoid the areas that are very speculative, unless you've got incredible information and know how to get in and out very quickly. It's much safer to buy generally in the capital cities and the larger regional areas. Another great strategy I love is positive cash flow. You generally can't go too far wrong if you're earning money from your property from day one. And there's a number of ways. I'll give you some case studies on how we do that for our clients. Buying a property, adding value, renovating, doing a kitchen, bathroom, floorboards, painting, that sort of thing is a great strategy. In this kind of rising market, it is possible to flip. Obviously, there's a lot of tax considerations around that, and I'm sure, Peter, you'll have some comments on that, but you've got obviously your stamp duty and your entry and exit costs with agents' fees certainly puts a big dent in your strategy, but I've seen some people do it quite successfully if they know how to flip well. Adding a granny flat, great way to create positive cash flow, get a secondary income from the property. And also, we're helping a lot of our clients buy properties still in their self-managed super fund. It hasn't gone out of fashion, and we still believe it's a good idea to go forward. So a couple of my buying tips in a crazy market like this one. Well, first step I would say is you must have your finance approved, your deposit ready in cash. Make sure you've got that finance. And I've just gone through a refinance myself. It's taken like 3 months. It's ridiculously slow at the moment with the banks, but I would recommend do persist, do use a broker. We can recommend one too if you need one, but it's very important you get that in place. Also have multiple buying options. Because of the lack of stock, you're going to face a lot of competition in the current market. So it's very important not to have your heart set on one property and be too emotionally attached to it if you're an investor. Also, if you're a home buyer, but you also need to move with speed. You also need to try and access off-market opportunities. And the way you do that is simply by creating relationships with local agents and being in the game every week. One of the things we do as a company really well is we've got an extensive agent database, over 3,500 agents. And I've literally just before this webinar sent an email to about 100 agents asking for off-market opportunities. And I just exchanged one last week for a client. You also got to be careful to evaluate the property. One of the things I'm seeing people do is pay stupid money for properties. So I'm talking, $300,000-$400,000 above what it's worth today. Now, sure, in time, you might make that money back, but you've got to be very careful, what you're paying today is representative of true market value. So look for recent comparable sales, make sure you understand the ins and outs, distance from shops, how close it is to busy roads, that sort of thing will definitely impact the value of your property. The other thing is just on a personal level, you have to watch what I call buyer fatigue. And I'm sure a lot of you out there have that, where you get incredibly frustrated that the market is just not delivering enough properties and you kind of give up. Well, the weekend that you give up might be the weekend that the right property pops up. So you've got to be persistent and just watch how you manage your own fatigue going forward. Some of the things that you've got to do to buy well is go through these 7 steps. And I won't go through them in detail, but essentially you've got to know your strategy, have a target, know the area that you're buying backward. You need to know median prices, days on market, vendor discounting. What are the drivers of that local market? Then you've got to shortlist, select and evaluate the right property, complete your due diligence, organise it, the appraisal and negotiate it and secure it well. And they're each of the 7 steps that we follow as a buyer's agent. So we follow a well-defined strategy, help our clients come up with that sort of brief. And having a professional negotiator on your side certainly makes a difference. And we certainly help you crunch the numbers. And just my little plug, obviously, we charge for that. We work on a fixed fee structure, and our fees range between 1.5% to 2%, depending on the purchase price. But you'll have one of my team members who's a specialist in the local area working with you, creating that strategy, accessing properties, reviewing them each week, and working alongside you on your side each step of the way. So that's the overview. We'll give you a couple of case studies that will highlight a couple of the strategies that I've talked about just a few moments ago. So one we just bought in Melbourne last month in Cheltenham. This was with Amanda Jones, who's our principal buyer's agent. She found this property off market through her network in Cheltenham. It was a 4-bed, 2-bath, 2-car on a good sized block of land. Didn't need a reno, really nice inside, just a perfect family home. We appraised that up to 135 and managed to secure that for 1,275. So certainly made a good saving there for our client. And it was just her relationship and the speed at which she was able to move enabled us to close that for our client there. In Brisbane, we've been targeting some both existing homes and also duplex blocks. So a lot of what I call the property spruikers would have plugged or flogged these kind of products to their clients 5 or 6 years ago, and some of them haven't seen a lot of growth, but now is actually the time where Brisbane is starting to shine. So we can pick these properties, these duplexes up for not much more than what the vendor originally would have paid for them. And we know that they're going to have some growth in the next 5 to 10 years and have a strong positive cash flow. So this one here we picked up for 495. It's giving a gross yield of 6.7%. It's got 3 beds on one side, 2 beds on the other. It looks like just an ordinary 4-bedroom home, but a great thing to have in your portfolio. Another one we've bought recently in the eastern suburbs. Some of the fringe suburbs, as you head out from the city, around Randwick, Kensington, those sort of areas, where a lot of the student accommodation used to be, has suffered a decline in demand. So we're finding that there's some good pockets of value around those areas. We bought this one at auction a couple of months ago, where typically the agents will underquote the price, but again, we managed to secure that for a really good value. One that I did a couple of weeks ago for a lovely family looking to move to the Northern Beaches. They had a very, very tight budget, up to 2.2, which is 2.2 is almost entry level now around the Forest area. But through our own website and through some social media work, I put out some posts and managed to find this property off market, not going through an agent, and got this. It was a 4-bed, 2-bath, had a pool in the rear, north facing at the back, and we picked it up for 2.15. Interestingly, this owner had several agents go through the property and told her they'd get 2.2 on the open market. But because we don't take any fees from the vendor, she was willing to sell it slightly under that 2.2 at the 215 mark for us. And the clients are moving in next week. So absolutely over the moon. Also, we're targeting some properties in the Sutherland Shire of Sydney. This is a bit of a miracle story. Stuart Fraser and our team managed to secure this property in Gymea Bay, Grays Point area at 1.5. And when the client took it to the bank to get their bank valuation, it came in at 1.65. Rarely ever happens. Probably 1 in 1,000 properties where the bank will value it higher than what we've paid for it. So incredible. Obviously, client absolutely over the moon, but that Sutherland Shire area is definitely going off. A lot of potential, beautiful waterways, national parks, and doing really well in the future. One of our more wealthy investors, we recently just transacted on this block of 4 units just near Merewether Beach, up near Newcastle. Our client had the cash and ready to go, cash and bank funds ready to go. And it was delivering a gross return of 4%. But the upside on this is just the long-term buy and hold and potentially to renovate these units over time. So again, found this off market. We bought it for 2.525, and that will be a fantastic long-term buy and hold for our client. Also, we're targeting areas in Western Sydney so that are getting benefit from Badgerys Creek Airport. The infrastructure that's going in there is quite incredible. All the new metro train lines that have been built have really attracted a lot of investors to come out of the woodwork. So we're finding that there's a lot of demand from investors, and those properties are selling generally within days, if not less than a week. So you have to jump on them really quickly. So we recently just bought this one for a client. Nothing much to write home about, but it's a classic 3-bed, 1-bath, 1-car home with a granny flat in the backyard for 807, and it's yielding a rent of 735 a week. So that was a really good opportunity. So they're just a couple of highlights, guys, of some strategies. I might just throw it open to, if you want to get in touch with me, there's my details, but we'll be sending around an email at the end of this with the notes, and if you'd like to get anything further. But if you've got any questions, I'll end the slideshow and then stop sharing. So I'll just go into chat box and questions. Okay, and Pete, feel free to jump in too if you've got any
no
problem to these. Question from Vicky: What do you think Vic recently increased stamp duty and land tax also introduced a new windfall tax will affect the Melbourne market? Yeah, so government's playing around with stamp duty. It's interesting they've increased it. New South Wales government is talking about removing it or replacing it. It definitely has a dampening effect, but I don't think it's going to have a dramatic effect. On the windfall tax to developers, I think that's an ill-advised strategy because a lot of there's a certain way they can do it, but I don't think it's going to be helpful to improving the supply of properties in core areas. So I don't think it's a very good strategy, not a well thought out strategy by government. Your thoughts, Peter?
Yeah, probably very similar, Rich, that I'm not sure during these times that we find ourselves in why you'd want to increase stamp duty. It's obviously a revenue grab, and they've copped a bit of flack for it down here in Victoria, but I can't see it again having a major effect on the market. Land tax also, there's a slight increase there. Yeah, again, it astounds me why they would do that at this point, but who are we to argue? So, yeah.
Well, we can make noise about it and write submissions.
We can,
sure.
yeah.
Absolutely. Question, do you think granny flats are a better option than subdividing and building a second residence if council allows? Well, I guess they're two different strategies. Firstly, granny flats are a great thing. Again, depending on where you're building them. In New South Wales, there's a legislation that generally allows you to build a 60 square metre flat pretty much anywhere if you're complying with the setbacks and the guidelines. In Brisbane, it's very council specific, as is in Victoria. I think granny flats are a good, relatively low cost option to create a secondary income. But if you can subdivide, even better, but it's more logistically difficult and more expensive and greater risks going forward. So again, do that research. From Martin, gentlemen, can I put a lump sum of money into my super as part of a separation payout to purchase a property? If so, how do I go about accessing that money? I've owned property previously, but no longer any property. I'm going to hand that one to you, Peter.
Yeah, sure. So if I understand the question correctly, it looks like there's a separation going on and someone wants to access their superannuation to tip into perhaps a private residence or that type of stuff. Generally, that's not going to be allowed. Sometimes you can access super to pay out your ex-partner, if that's the right word to use. But generally, just to have access to go and invest is generally not applicable. There may be some opportunities depending upon your age, Martin, and other areas we could look at, but generally the answer to that would be no.
Great, thank you. From Sina, how do I buy property independent from my income? I'll soon be 60 and might stop working. Extremely difficult. You need lots of cash in the bank if you're going to go and do that. So very hard to buy property unless you have an income, but I would advise you to get some advice both from a financial planner and from a finance broker to work out your budget, and that's your first step for moving forward. But I'd say to you, don't stop working if you're planning to buy property anytime soon. But That's why we advise our clients, start buying property, accumulating a portfolio as early as you can in life. And what you do by nurturing that portfolio, it will nurture you in later life. Question, the example with the granny flat, is that leased separately to the house? Yes, it is. We have a property manager that will manage both the house and the granny flat separately. And as long as you've got a good privacy fence between the two properties, there's generally no issues, and they can be managed. How is the Toowoomba for investment? Well, Toowoomba, again, about 90 minutes west of Brisbane. Yeah, good area for investing. I don't think it's quite as strong as Brisbane personally. If I had the money, I'd be putting it into the Brisbane market. But Toowoomba's a lovely area, surrounded by some great agricultural industries. It's got its own private airport. So I definitely think it's got some legs. What do you think about the future of the Central Coast area? Okay, so love this one. Very, very strong. Terry Ryder, who's one of our friends and independent researchers, recently written some reports about the Central Coast, and he talks about the flight to lifestyle. There's so many people now with COVID who can work from home, and the Central Coast has some beautiful waterways. It's only an hour from Sydney, an hour from Newcastle. We think it's going to be very strong. A lot of my friends, a lot of first home buyers have all moved there. We think it's got a lot of legs going forward from here. Question about commercial property. Are any areas of opportunity? What about change in yields? Okay, so with commercial property, again, we think it's absolutely got some very good, strong opportunities, but you're right, yields have compressed and will continue to compress as money is cheap. So you've got to be careful what you buy in the commercial market. So many people have been impacted, unfortunately, through COVID, through retail, food and beverage outlets, gyms, whatever, have all been impacted. So whatever you buy, even though there might be a lease in place, you've got to look at the business that's behind that lease and make sure that's going to be a sustainable kind of business, because with commercial, there's a much higher risk of vacancy for a longer period of time. Unlike in residential, you can drop the rent $20, $30 and quickly get a tenant. If your commercial property doesn't have an alternate use, or it's not in a good area for foot traffic, you could be left holding the baby for quite some time. Probably just a couple more, Pete, and then we'll hand over to you. I don't want to cut you short of time. Have you seen a drop-off in access to off-market properties, given how the market is? Yeah, interesting about that one. Off-market, we have seen, generally we get a lot of properties off-market. I mean, even up to 50% of our business sometimes is doing off-market transactions in certain suburbs. But with COVID, the real shortage of listing, we haven't had as many as we normally have. However, that tide is turning again now. Because of the lockdowns, we're actually getting more off-markets than we've ever had before. So it ebbs and flows. But I do think people are a bit scared sometimes to have people through their home, or for whatever reason, they'll sell off-market. So it's a strategy that a lot more agents are embracing and that we can take advantage of. Last question. Hi guys, just wondering why some accounts don't like buying off the plan and super fund borrowing money to buy the property. Off the plan, yeah. Look, for me, there's a much bigger risk buying off plan. I much prefer to buy established properties for our clients, unless there's a really compelling reason and there's a really strong developer behind the off the plan. I've personally bought off the plan very well and not so well, so I can learn by my own mistakes. So we like to buy 99% of our stuff for established properties because we know it's a known quantity. And obviously it's a bit on the nose because of the Mascot Towers and the Opal Towers debacle. So again, just be really careful when you're going through that strategy. So look, I've used up my 25 minutes on the dot, Pete, left you enough time. So can I hand over to you to please enlighten us with some great tax advice?
Yeah, sure, no worries. And I'll just share my screen here. Hopefully, is that the wrong way around?
That's it. Just do.
Bingo.
Perfect. You got it, mate. Well done.
All right. So firstly, thank you for the opportunity, Rich. Really appreciate it. And hopefully, yeah, I'll give some tips. So basically, yeah, I hope you're all remaining safe and well, both up there in New South and certainly down here in Victoria. Our lockdown as of an hour ago has just been extended. So it feels like we're in Groundhog Day with probably the last 6 or 12 months that we've gone through, but hopefully the whole country gets out of this mess and we can get back to some normality, if that's the right word to use. All right, let's have a look at it all. So myself, Peter Lacandro is my name. Yes, managing partner here at Chan and Naylor in Melbourne. We have a couple of offices in Melbourne. We've got the entire team working remotely at the moment for obvious reasons. However, like many other businesses and clients that we look after, we've all needed to adapt with technology and fast track things to the best of our ability, and we're certainly nothing different. We help many of our clients around, obviously, tax and accounting and wealth creation, and very big on SMSFs these days, which I'll cover a little bit in a moment, along with the insurances, and structuring is a very big thing. I noticed one of the questions was, should I utilise a trust or a company to invest rather than my own name? So I'll certainly cover a little bit with that side of things for you as well. Just a little bit, a tip straight off the bat. What I usually recommend to our clients is that you build yourself a network of experts around you to help you achieve whatever your goals and objectives are. That would include a property advocate, obviously an accountant like ourselves. And this must be for both your business and for your wealth purposes as well. You should have a great loan broker alongside that you can always make a quick phone call to, or like Rich alluded to earlier before, to refinance, especially in these days with the banks offering such great rates, etc. A good financial planner would also go a long way towards assisting with what the future looks like, along with things like insurances, etc. And also a decent conveyancer and solicitor wouldn't hurt at the same time. When we're looking at buying those properties, you want someone you can trust and will get back to you very quickly to have a look at a Section 32 or a contract of purchase, for example. Our focus down at Chan and Naylor is all about educating our clients. We're not the type to tell you what to do and how to do it, but certainly we educate you so that you understand a lot more and you can make some better informed decisions. Your focus, and certainly there's no time like the present during a lockdown, is to invest in yourself. Do some reading, speak to the right people, attend seminars and webinars like these ones, listen to podcasts. Whatever you can do to invest in yourself goes a long way towards making some right decisions and building that wealth for yourself in the future as well. Very important. All right, before I get stuck into some contact, unfortunately, my legal eagles, I must say that this is all general advice only. Any information is general and does not suit your circumstances. So there's many rules, there's many strategies out there that many of our clients and businesses use to help them build wealth, legally minimise tax. Obviously, we'll cover a few of them today, but please seek your appropriate advice before you act on any of this. And if you need help, we're always here to assist you in whatever we can. All right, so today's agenda, or what Rich and the team have asked me to talk about, is quickly to cover what the ATO are running hot on this year. So generally speaking, the ATO audit activity is ramping up, so I'll cover some, give you a few tips there. What can we claim, especially working from home, which many of us are currently doing and have done over the last 6 or 12 months. So there's some special relief there from the government and the ATO. What are some of the best structures, or what are the options around structuring to invest in property? We'll look at some tax deductions available for property investment out there. We'll quickly cover SMSFs and investing in property, and is it still worth it? I'll give you a few tips with the banks and keeping them honest. And then basically what to do next, I think, is the key. Whenever you listen to webinars and talk to people, it should be about what should I be doing next to help me get to the next stage of my investment cycle. So let's get stuck into it. So before we have a look at some tax strategies, please be careful. The ATO and the government have spent a lot of money over the last 15 to 18 months, obviously with grants and job keepers and everything like that. Please be careful. They are now starting to investigate and prosecute, which we've already seen some of this happen as at our end as accountants. Not just, you know, there's been reports, some of the wrongful claims around JobKeeper, tax return lodgements are getting scrutinised a lot more. So just like you and I are trained to do our jobs, the ATO investigators are trained to do theirs. They're also using technology out there to the best of their ability in the form of data matching programs, averaging programs to bring to account the areas or the taxpayers that they should audit. We'll have a little bit of a look at businesses that they're targeting. So what are some of the common areas? So with businesses, basically, they are closely looking at SGC. So, you know, for those of you like me that employ team members or staff, have you paid your SGC? And was it paid on time, which is the other big factor. If your accountant hasn't told you already or you don't know, the super guarantee charge went up from 9.5% to 10% as of July 1, and it's programmed to increase in the coming years as well, up to 12%. So very, very important that if you're using, you know, for example, Xero software or whatever that may be for your business to do payroll, that you're keeping up to date with the super. They're all over it. JobKeeper, we've all read the press and looked in the media, and yes, there have been some wrongful claims. So the ATO are after all that, and they certainly are starting to ask questions. They're also checking out wages and payments to employees. So many of you, you know, may own small businesses where, you know, you should be paying an hourly rate or a minimum of X per week and stuff like that, or public holidays should be extra. Be very, very careful that you're all over the correct payments. The number one, or there's two major factors why the ATO investigate. Number one, if you're going through a marriage breakdown or a relationship breakdown, the biggest reason is, let's just say your ex may make a non-disclosure phone call to the ATO. So be very careful in that regard. And the other reason around wages and super especially is where you have a disgruntled employee can also contact the ATO and give them information that they may not necessarily be able to find. So be very careful with wages and super. And there's also a special rule which was introduced by the government, the 150,000 write-off for purchases of plant and equipment and fixtures and fittings. That applies to June next year, but be very, very careful. You're just ticking the right boxes and doing the right thing there, because it's a massive incentive, and I'm sure many of you out there have taken advantage of that, but just make sure that you're doing the right thing. So that's what they're targeting around businesses. For those individuals or personally out there, motor vehicles is a big one. Now, like I said, here in Victoria, we've been stuck in our studies or in our lounge rooms for 6 or 12 months. So you probably find you might not have too much in motor vehicle expenses, especially when you've got a radius of 5 kilometres is all you can travel. But be very careful that your logbook's up to date. Has it been kept accurately, and what you should do? Because we're starting to find the ATO are asking for copies of logbooks. There's even technology out there that you can use that's a lot friendlier, easier, and more accurate as well. Working from home is going to be the big one this year, because I'm sure, and we've already seen, we're already preparing our clients' 2021 tax returns and the increase in the working from home allowances. I'm going to cover that separately in the moment, because the government have provided a special COVID strategy that you can utilise. Protective clothing and compulsory uniform. So you can't just claim clothing that you wear to work. That must come under certain categories. So please talk to your accountant or be all over that type of thing. Work-related expenses. So many of us out there, have maybe bought equipment, IT, stuff that we need to work from home, even down to furniture and desks and things like that. Be very, very careful and speak to your accountant. That $150,000 rule that I mentioned does not apply to employees or pay-as-you-go earners. You are still there at a $300 level, or you must depreciate thereafter. So just be very careful of what you're claiming and what the business use percentage of it is as well. Rental properties out there, they certainly have their common yearly things that they look at, and the big one, like always, is the difference between repairs that you may undertake versus capital expenditure on a property. So we are finding at the moment there are a lot of people renovating their home, maybe doing that kitchen upgrade with their investment property or the bathroom. So you need to be very, very careful. The general rule is to claim repairs and maintenance on an investment property. It must be as a result of tenant damage or tenant wear and tear, not an upgrade. So what should you be doing? I would be taking photos pre and post the renovation. I would be making notes. You need to make sure that your invoicing is worded correctly. All these things will go a long way towards helping if and when the ATO asks questions, okay? So the message here is be careful. They are watching. So just have all your ducks lined up and all your record keeping in check is very, very important. All right, let's get stuck into some of the strategies. So the first thing that I wanted to cover, working from home has exploded. And it's very important that you make sure you're aware of the do's and don'ts. Just like Rich, you just mentioned the Central Coast. Here in regional Victoria, up on the Mornington Peninsula, the prices have just exploded. And that's simply because a lot of people are working from home, or a lot of people, might only have to go into the office 2 days out of the 5 now. So they're prepared to travel those couple of days and settle down an hour from the city. So this is where working from home has certainly exploded. In general, if you're an employee who works from home, yes, you may be able to claim a deduction for the expenses that you incur that relate to your work activities. To claim that deduction, you need to be working from home to fulfill your employment duties, not just carrying out tasks such as occasionally checking an email or taking a phone call. You physically must be sitting there working from home for a decent period of the time. And you also must incur additional expenses as a result from working from home. So that would be, for example, extra electricity and gas, extra internet, extra, a lot of clients have upgraded their internet plans, or certainly have the electricity bills to prove that they're doing 8 or 10 hours at home each day. So that's very, very important. If you're a sole trader or a business owner, perhaps, and your home is now used or was even used as your principal place of residence, then there are certain things you can also do. I probably haven't got the time to get stuck into that in a lot more detail, but be aware that you can make some claims there as well. Like I said, how do we make a claim for working from home? In simple terms, you can use one of these 3 methods, which I'll go through, to calculate what your deduction will be. And you can also must keep the records to show how you incurred those expenses. So you know, electricity bills, your telephone bills, your internet bills. So there are generally 2 rates, but the government have added this third one called a shortcut method. And this is obviously specially for COVID-19. It was made available on the 1st of March last year, and it finished on the 30th of June this year. So really it's only for this year's tax return and a little bit of last. It'll be interesting to see if the government increase it or certainly push that timeline out, considering half the country's now in lockdown. So, and hopefully that won't last too long. So how do we basically do, or what did they do with that method? It basically, you need to keep a log of your hours from working from home. So like I said, it's not just checking an email. You know, you get out of bed, you do what you got to do, and you walk into your study, for example, or your lounge that's set up, and you can generally claim 80 cents for each hour that you work from home. Yes, you must have records and receipts, and I would suggest you keep a little bit of a work diary or a little bit of a log of those hours, just to make sure. If you can get a letter from your employer to verify that's what you're doing, even better. But it's important that basically you can back that up, because they are even asking those questions. If you, however, decide to follow this method where you claim 80 cents per hour, you cannot claim any other expenses from working from home. It's an all-encompassing number. So that will cover your phone, your internet, your electricity and gas. It will cover also a depreciation in your equipment or furniture that you've bought. So you need to be aware that it's an all-encompassing rate. It can add up quite quickly, especially considering if you're doing 40 hours a week at home and you've done that for the last 6 months, for argument's sake. So speak to your accountants or yell out if you need any further help. Make sure you have the right details, because the ATO are on the prowl and will be checking that, because it'll be a massive claim that many of our clients have made and will continue to make. We quickly spoke about structuring. So it's one of the biggest things I think people ignore or try and fix up down the track when it poses other problems. So I'm sure you'd agree, Rich, that this should all be in place well before you sign a contract.
Can I jump in there, Peter? Can I just say, from my own experience, do it right the first time. It's
Correct.
Very expensive to unscramble the egg, and get the structure right from the first day, from day dot.
Yeah, 100%. And when we're looking at buying an investment, and I'm sure everyone out there will agree, there's a number of things we should consider. And, you know, the number one most people look at is minimizing legally their taxes. And we've all heard about negative gearing, and I'll quickly cover that in a moment. But there should also be other things that come to mind around asset protection. And it's not just that one property that you're buying today. If your objective is to build a property portfolio, you know, and that might come over the next 5 or 10 years, you could have properties worth $10 million down the track, and they'll double and triple in value. So it's even important, not just for today, but for tomorrow as well. Estate planning, you know, death and taxes, as they say, are the 2 certainties in life. But, you know, unfortunately, if something drastic was to happen tomorrow, have you got a will in place? Depending upon who or what and how you own your investments will go a long way towards whether your loved ones will get hit with taxes. You know, the government back in the 80s got rid of death duties. Guess what? They brought a thing in called capital gains tax, and death triggers that straight away. So that's where you need the proper advice and the proper structures in place to ensure that your wealth passes from generation to generation. And part of it as well is control versus ownership. Many people want ownership and they want control, but there's also ways that you can do it and still maintain both, but suit it for tax purposes, for asset protection purposes. So again, I agree totally. Please, but if you're wanting to do this, it's a very, very small cost, maybe speaking to an expert for 1 hour to get a tips on what your options are. So when you look at the big picture, it's next to nothing. So speak to the experts. You know, sometimes I have clients that will walk in, Pete, you'll be very happy with me. I bought a property this year. Oh, fantastic. Well done. You didn't ring me to ask questions. No, I spoke to my brother-in-law. Oh, is he an accountant or a finance broker? No, he's a plumber, but this is what he did. But why does his circumstances suit yours? So that's where everyone's circumstances are totally different. So property ownership, do not just look at year one. Very rarely do people buy properties and flip them immediately. And if that's the case, that's okay. We only have to look at the current picture. But generally speaking, property investment should be a medium to long-term investment. Therefore, don't just look at the tax effect for year one or your asset requirements today. What looks like in 5 years? Now, when should we be doing this? Ideally, well before you sign a contract, because that's the name that you would put on a contract is, generally speaking, what you will be stuck with. And that will determine your tax liabilities, your asset protection, all of the above. All right, so very, very important. If you get one thing out of this seminar, it's talk to the experts pre-buying. What are some of the options out there? So generally speaking, yeah, we can all sign a contract today and we can buy individually, or it might be husband and wife, or a couple of brothers together, or a couple of siblings together. So generally that can happen. And yes, that is the easiest and cost-effective way of doing it. Not necessarily the best though. Sometimes people use companies to buy properties in their own capacity. It's a common thing where it's a commercial property, perhaps business premises, for example. Not very good though in terms of capital gains tax implications down the track, if and when the property doubles or triples in value. When you have a company, it's also very, very difficult to strip the profits out of a company without getting hit on those taxes personally. So not a preferred option. Probably the biggest two that we see out there is trusts and self-managed super funds. And a self-managed super fund is actually a form of a trust anyway. So trusts, we can have unit trusts, we have discretionary, or we have a hybrid between the two. And generally what that allows is the maximum asset protection if it's set up properly, and can also allow profits to be distributed in a much easier and tax-effective manner as well. And that will go a long way towards your personal circumstances, your family situation. More than happy to chat to you about that. Self-managed super funds are still a very big market out there, although it has slowed down compared to a few years back. Basically, the Howard government at the time in the mid 2000s there, they changed the laws where super funds under certain circumstances could borrow money, which they never had the ability to do so previously. As a result of that, a lot of people now use super funds to their advantage, where they'll basically, for example, husband and wife may pool their super balances together, and that represents a decent deposit, or they can almost pay cash in buying properties. Very, very big as well, where the business wants to own their own business premises, and then the business can pay rent to the super fund, get a tax deduction for it, and the super fund uses that rent to then pay down the loan or to build wealth for later on in life. So super funds can be quite advantageous if the right boxes are ticked. Is very difficult though when we come to financing and banks and all these strategies. So it's a hell of a lot longer process. So please Don't ring me that if you signed a contract on Saturday and settlements in 60 days and you put it under your super fund. You want to make sure you get the right advice well before that you can actually do that. So we don't have enough time to really get in depth with each one of them. But the number 3 with the trusts and number 4 with the super funds are something that you should at least consider. At least understand how they work, what the pros and cons are with each of them before you then sign the contract. All right, very important. So if you need some more information in that regard, feel free to jump onto our website. There's a section there called investment structures, and download all the information you'd like to have a look at and read and all that type of stuff. The one tip, get educated, spend a little bit of money. It will save you possibly tens of thousands in the future. And if it's not you, it will your loved ones. Whenever you're buying a property and choosing which structure or whose name should appear on the contract, it's pretty simple. It's a cost versus benefit analysis, guys. And you can't put it any more simple than that. What's important to you may be different to me or Rich or anyone else. So it's important to analyse it based upon your circumstances. Quickly, just to cover negative gearing, I'm sure most of you out there have either done this or understand how it works, but it's pretty much a strategy where the rental property expenses exceed the income. That's a classic example of negative gearing. It is a tax structure only. You know, I tend to agree with Rich that if you can find a positive geared property, then it's great. That'll help you retire later on in life. If you're making a loss every year, you're banking that the capital growth will exceed the money that's coming out of your pocket. And right at the moment, yeah, that's probably happening. But what happens next year? What happened 3 years ago? That's the biggest factor. And remember, the government can flip at any point. You know, the Labor Party went to the last election with the possibility of changing the negative gearing laws. What happens if you enter such a strategy and all of a sudden that switch is flipped? You might be in a bit of trouble cash flow wise. So just be very, very careful. But property investment, to me, should be about wealth creation. Negative gearing and losing money on a property probably doesn't fall in the same dictionary as wealth creation. So be very careful, guys. Get the right advice as well. Ongoing tax benefits with property. So very important. You know, generally speaking, it doesn't matter what the structure is. The same tax deductions will be available for investment properties. We've got the normal ones around depreciation, interest. We spoke quickly about repairs versus capital upgrades, so be very careful. Get educated, understand what you can and cannot do. Again, jump onto our website. There's a brochure there on every single thing that you can claim with a rental property. The tax rules are pretty clear as well. If you didn't pay it by June 30, it's not deductible. You need to wait till next year. Okay, so just be very careful in that regard. But certainly one thing that you can do, get educated on what you can claim and what's legal versus not legal. Very, very important. How am I going with time? Am I okay, Rich?
You're going well, mate. Yep, we're all good.
All right. So I'll quickly just cover on depreciation. There's only a couple more slides left. Depreciation, there's generally 2 types. What I call normal, so that would be on plant and equipment, which would cover things like your curtains, your split system air conditioner, your dishwashers, those general things which are on average are accelerated at about 20% per annum, a little bit more, a little bit less sometimes. We also have structural depreciation. So that on any property, you can see residential 1987 that was built after that date, you can generally claim 2.5% per annum on a residential on the structural building costs. Rich can't, I can't just guesstimate that for you. You need to get a property surveyor involved, or what's referred to as a quantity surveyor. There's plenty of businesses out there that do it, which will give you a full-blown property tax depreciation report. Generally, it'll cost you $500-600, which is also a tax deduction, but certainly worth getting it done. And the great thing about depreciation, guys, is it's a tax deduction for you, so it'll minimise your taxes, but it's a non-cash flow item. It's not coming out of your pocket every week or every month. So very, very good for tax purposes to get it done. Quickly, banks and finance is very hot out there, and so it should be with the way interest rates are. What is LVR, which we hear about? It's basically loan to value ratio, and it's generally your loan amount compared to the property value will give you an LVR. The lower that is, the better. Number one, it means that you're not bleeding money out of your rental income or out of your wages, having to subsidise it. Or it also means that if you want to buy that next property, the governments will, not the government, sorry, the banks will look at you more favourably because they'll probably lend more to you. So you should always drive that down as far as possible. Again, if you want to have a read of it and, you know, some of the questions that we get asked, what's the difference between fixed and variable rates and which one should I follow? Jump onto our website and download some of the brochures. Keeping the banks honest is a very big thing that I hope to God you should all be doing right at the moment. The banks love when they offer you a loan, and guess what? They give you 25 or 30 years to repay it. I hope to God you're not waiting 25 years to check that loan and the terms and conditions though, which we commonly see when we pick up new clients and do their tax returns. You should be refinancing now if you haven't done so, probably in the last 12 to 24 months. For those of you with investment loans out there, if your interest rate is not starting with a 2, you're probably paying too much, guys. If your PPR loans are not starting possibly with a 1 at the moment, again, the banks are not going to send you a Christmas card or ring you up one day and say, oh, good on you, Pete, you've given us a few extra $1,000 this year, here's a refund. They'll take your money. They won't be proactive and ring you. You need to take action. So great, Rich can refer you to a loan broker if you need help. We've also got Lucy on our staff, but go shopping. It's a free service to you. What are you waiting for? If you like giving the bank, you know, one client said to me a little while back, oh, Pete, I'm happy to pay a higher interest rate because I own some shares and I'm getting a dividend back. Trust me, you're still out of pocket. So make sure you're keeping your banks honest, guys. Very important.
And Pete, I'll just jump in there on that one too.
Yep.
As I said, I've just gone through a refinance myself, and it's an absolute pain in the backside to get all your paperwork, all your tax returns in, but it is worth it. You know, I've just refinanced my home loan at 1.79% with CBA.
There you go.
You know, and I can also get an investment loan at like 2.19 or 2.29. I can't remember the exact number.
Yeah.
2 years. Now the 2-year rates are the cheapest on the market at the moment. I think they'll probably change upward in about 2 or 3 months' time. So if you are looking at doing a refi, do it now. It's worth the effort. It's worth the pain. As you said, why give the banks extra money that they don't need?
100%. And that'll also, for those of you that have the objective of building your property portfolio, the cheaper the rates are, the more principal you're repaying. Guess what, guys? Or the more cash flow that leaves in your pocket, which means that LVR works in your favour and the banks will probably lend you more money. So the bottom line is it can fast track your property growth and property objectives that you're wanting to achieve. So yeah, I know what I'd be doing, and I tend to agree that I'm starting to see some slight little things where the banks are starting to adjust things upwards. So I'd be jumping onto that one yesterday. If you need help, yell out, not a problem at all. What are the next steps, guys? So what should you be doing, or what do you need to educate yourself on? Okay, no one's, again, they're not going to knock on your door. You need to take action. Who's in your network to assist you? Whether it's an accountant, whether it's a property advocate like Rich, whether it's anyone else, who do you need to talk to? Who do you need to seek out to at least educate you on your options? Might not work out today. You know, sometimes I talk to clients and they'll ring me 12 months later or 6 months later, whatever that is. That's okay. But again, who's in your network? And most importantly, what are your goals and objectives? Because if you don't know that, or you're not sure, then what are you trying to achieve? Is it long-term? Is it positive cash flow? Is it capital growth? Is it transfer wealth to the next generation? What are your goals and objectives? That's the key. All right, so from my perspective, thank you very much. I'm here to talk to anyone. There's my contact details. We'll pop this recording on our website as well. Yell out. Again, one other tip, the ATO are watching. Make sure your compliances are all up to date, guys. Because even, for example, if you want to buy a property and you need assistance with finance, then guess what? If your tax returns are not up to date, you've got Buckley's chance of that actually happening, guys. So again, one recommendation is get everything up to date. All right, but I'll stop sharing my screen if that's okay.
That'd be great, Pete. If you just go back to normal screen, you're just hitting stop share.
Where do I?
Yeah.
Oh, there it is, that button.
Perfect.
Bingo. How's that?
Excellent, mate. So thank you. We've got, before, just to wrap it up for the next 5 or 10 minutes, we've got a couple of questions. So we'll just start on the, go to the chat box. I've answered quite a few questions for people while you've been chatting. But just pick out what you think is the most important ones to answer.
Yeah, sure.
So
I've just got a couple here. What do we got? Jorg, so hi Peter, in relation to logging hours working from home, would a weekly timesheet submitted to my employer suffice? Yeah, weekly timesheet would be perfect. A little diary, whatever you want to call it. You do not need to lodge it or submit it to your employer. It's more when you go to lodge a tax return and you claim, for example, 38 hours per week, that you've just got some log or some diary that's what you've done. Sometimes it's also good for an employer just to sign a letter to say, yes, you're working from home during these hours. Just a bit of extra record keeping, that's all. Michelle, what's the best long-term strategy if you have not set up structures, have invested in your own name and are now stuck with large land tax and income tax bills? Yeah, very, very difficult, Michelle, that once you've done something, it's very difficult to unwind it. I have done it on numerous occasions. However, the things that apply are capital gains tax, possible stamp duty, and yeah, land tax is quite ugly, and generally that won't disappear even if you use structures. So until I probably understand more, it's pretty hard for me to say yes or no, but very difficult once you've done it. So I think the key message is speak to your accountant or myself, whatever it is, Rich. I always encourage clients that if it's their objective to buy, say, a property in the next 6 months, set that structure up, have it sitting on a shelf, ready to go. If it costs you a couple of $100 a year and an ASIC fee just to keep it on the shelf, that's okay, guys. But it's ready to go and you're ready. If you rock up to an auction, you know the name that you need to put on the contract. If Rich rings you with an off-market property that you've got 24 hours to make a decision on, bang, it's ready to go. All right. Should you buy 7-year-old property for investment or buy new ones? It depends on so many factors. The one thing I would say is forget about the 7 years, but established versus new home. Generally, a new home will just give you a bigger depreciation claim on your tax return. It still comes down to what are your objectives? What are you chasing? What's the value that you're paying for both of them? There's no black or white answer for that one. Again, it would be sitting down, understanding the difference between the two, and that cost versus benefit analysis, Yugish. So what percentage?
Can I just jump in there, Peter, on that one?
Oh.
7-year-old versus, sort of new versus old argument. As I said, often the new properties you're paying a developer's margin. And for a developer to make a profit, they've got to sell at the top retail price generally. Whereas if you buy a more established property, typically they're going to be in more established areas. And that's why it's so important to get the strategy right and the location right from the word go, depending on your budget, depending on your age, your stage, there's a whole bunch of factors. So if people ask me, where's the best spot to invest? There's hundreds of spots to invest. I've got to unpack that question and help you decide. So generally, it generally won't be a brand new property because we think they're better value longer term to buy existing properties on most occasions.
Okay, no worries. Pedram, what percentage of your clients are from interstate? Oh, how long's a piece of string? Probably. All I can say there is we have plenty of clients interstate. I also have them overseas as well. Pedram, that's what happens when I have 2 kids living in America following their basketball dreams. So generally, we have plenty of clients, and if anything good has come out of this COVID mess, technology and things like we're doing right now with webinars, etc., is massive. So happy to help if that's what you're after. Selman, if we claim depreciation now, do we have to pay tax at the time of selling the property? Yeah, great question. So generally, if I purchase a property, say for 700,000, and I'm claiming depreciation of say $3,000 per annum, that will reduce from the structural side the cost base of the property. So eventually, when you sell it, you will have to pay some GST. CGT, sorry, not GST, on the sale of that property. But again, it's the big question, putting money in your pocket today versus what is the effect in the future. So that's the question you'd ask. If we hold an investment property for more than 7 years, how long do we need to live in the property as PPR before selling to maximise the CGT reduction? That's a very good question and a strategy that many clients use. I can't, without understanding a hell of a lot more circumstances, answer it in black or white. Generally speaking, the longer a property is your PPR compared to an investment, it will then go a long way towards minimising CGT, but it just depends on so many factors, it's not funny. Is it a good idea to fix a home loan for 4 years? It's probably a question for a loan broker at the time and depends on your circumstances. I always get worried fixing it for that long, to be honest. I think if you can fix something for 1 or 2, even up to 3, it's probably a better idea. And again, this COVID, who would have thought, 2 years ago, supposedly the market, or even back in March last year, dropped in the backside, and who would have thought, interest rates would be where they are right now. So I think it's always danger when you're locking things in for greater than 2 or 3 years. So just be very careful. Which banks are giving investment rates of 2.19? I think you said National, was that right?
No, I think it's CBA. I think it's
CBA.
I think it's 2.29. I can't remember, but it's roughly around that number. Yeah. That was a fixed 2-year rate.
Yeah, and I did have, I know the NAB, I know Lucy helped someone last week, I think it was at about 2.39, and that was with the NAB as well. So generally, the key there is shop the banks against each other. And that's what a decent loan broker will do for you, guys. They'll go shopping on your behalf. Then they'll put the best 2 or 3 deals in front of you and say, what would you prefer? And what's important to you? So let the experts do that work for you is the key. You don't need to walk into the branch and ask them. A loan broker has a lot more pull than you and I would. I just refinanced my loans 4 months ago. Can I refinance again? you probably could try, but it's probably not worth it, providing you got a good deal 4 months ago. Probably talk to your loan broker. You need to be very, very careful of what's referred to as clawback commissions as well in that instance. So P&I, did you say CBA at 1.79%?
Yeah, that was a fixed 2-year rate.
Fixed 2-year rate, there you go. Peter, who is your equivalent in Sydney? Was probably no one my equivalent in Sydney. I'll take that as a compliment. So I'm not sure. Young 27-year-old looking to invest, reinvest, live in a villa, claim business portion. It's probably quite...
I think the question here is, how do you compare the two between Brisbane or Sydney? So I'll answer that one.
Yeah, go for it.
Essentially, Brisbane, you'll get slightly higher yields. So for example, if you're buying, say, a $450,000 house, you'll get about $450 a week in rent. Now, you won't generally find a property of $450K in Sydney. It'll be more like 800,000, and on that 800K property, you probably get lucky to get $500 a week, 450, something like that. So if you're going to buy in Sydney, it's probably have possibly a slightly higher long-term capital growth rate, but a lower yield, versus Brisbane, which have a higher yield, but still good growth, but perhaps not just quite as high as Brisbane. But having said that, I do believe Brisbane the next 2 to 3 years is going to show very, very strong growth. So I think the window of opportunity to buy in Brizzy is very much now, and you can get some great quality properties up there, even despite a hot market.
Yep, sure. Just a couple more because I'm wary of time. Is it easy to get a loan as an individual compared to a trust? Generally speaking, it should be the same. And what do I mean by that? A bank will look at your trust, but they will also look at you as an individual, from your wages to your what they refer to as passive income, so other investment income. Through a trust, they'll also ask for a personal guarantee, most likely as well. So again, a decent loan broker will be able to sort all that out for you, Ari. Hi, Peter. What is the clear rule to separate repair expense versus capital expenditure? Vicky, there is no black or white rule, Vicky. It totally depends upon what you're doing, why you're doing it, when you're doing it. Again, if I just reiterate, a repair has to result as a result of tenant damage or wear and tear. You know, if your tenant's been in there for 3 years and you want to give it a fresh lick of paint before the new tenant shifts in, that's okay. You can argue that. If, however, you buy a property and you want to give it that fresh coat of paint before the tenant comes in, well, guess what? There is no direct connection between wear and tear and that repair. So that would form part of capital. So that's where, again, the proper advice is very, very important. All right.
And maybe just one more, Peter. This one, if I move into my investment property before selling it to avoid CGT, how long do I have to live in it?
Yeah, it depends upon how long the investment has been in investment would be the first thing. Has it changed in market value? Generally speaking, a lot of people have heard of a 6-year rule. That is not black and white as well, though. But generally speaking, I'd seek advice because every situation is different.
Cool.
Yeah.
Look, I know everyone's asked a lot of questions and there's heaps more. Sorry, guys. We will have to wrap it up just in the interest of time. But can I just say, Peter, thank you so much for sharing your knowledge today. You're always a fountain of wisdom. Appreciate
no problem.
it.
Thank you for inviting me.
Pleasure. And also thank everyone for spending your time in lockdown today, just watching this. We will be sending out a link to the recording. And if you've got other questions or you'd like our help with anything, please feel free to reach out. We'll help you as best as we can. But can I just wrap it up and say thank you again. Stay safe, wear your masks, and we look forward to helping you on your property and tax journey. Thanks again.
Thank you. See you guys.